Hi everyone. What this short video is going to look at is a profit and loss incentive for why companies would prefer to classify a lease as an operating lease versus a finance lease. So to do that, we're going to have to set up a lease structure, or at least some information about a lease structure. So we'll give it a fair value of $614,457. This is an arbitrary number which will make sense in a moment. Repayments are annual and in arrears, so they'll happen at the end of each year. The lease term is for 10 years. The useful life is also 10 years, just to make life easy. The residual value is 0. The implicit rate of interest is 10%, so lots of 10s turning up in this. And the present value of the minimum lease payments we don't know at this point. So that's the information from the lease. Good thing to do now is to set up the lease amortization schedule. We don't know what the opening balance is at this point. I should actually put in the period here. The opening balance, the interest component, the cash flow, the change in the principal, and the close. Now we have 1, 2 down to 10. Make all these dollars. Now the cash flows we know are $100,000. So I'm just going to take them down. So we know the cash flow is $100,000. Now the opening balance for the lease liability, and in this case it's going to be the lease asset as well, because there are no additional costs getting involved, is the lower of the fair value and the present value of minimum lease payments. So we need to calculate the present value of minimum lease payments. And in this case, it's a net present value formula. We use 10%, so we go up to cell C7. And the cash flows, and that gives us $614,457, which is the same as what we had as a fair value. So we can use either of them. And you use fair value. The interest component is the opening balance times by the implicit rate. I'm going to hard paste this to make sure that it always looks up cell C7. The change is just the difference between interest and cash flow. And the close is going to be the opening plus that change. The new opening is the close from the previous year. The interest stays the same, so it's just the opening times the implicit rate. The change will still be the interest and the cash flow, and the close will be the opening adjusted by the change. I can drag all of these to speed it up. And we end up with $1 down there, but there's obviously been a rounding issue going on, and that's because I used the fair value rather than the net present. So if I come down here, because we can see, not in there, but there's going to be some decimal places which we didn't take into account. Get rid of all the decimals. Sorry, just these decimals. Now, the interest is an interest expense, so I'm going to highlight that. So we have interest expense. We also have depreciation expense if you're to finance lease. So the depreciation expense will be, this is the asset. I mean, it's a liability in this one, but that is also the asset that would be recognized. And it's over 10 years with zero residual, and we're assuming straight line depreciation. So we end up with a depreciation expense of $61,000 each year. So the total expense for a finance lease is the interest cost plus the depreciation. So in year one, the total expense for a finance lease is $122,000, and the total expense in time 10 is $70,000. For an operating lease, it is simply the cash flow, because we would be debiting operating lease expense, credit cash flow, credit cash in each case. So it's $100,000. To make this more clear, we're going to throw in a graph, change the axis, expand this, and what we see is for a finance lease, the expense starts quite high but then drops each year to be a lot lower in the later years of the lease, whereas an operating lease, it stays constant, at least in this lease setup that we have here. So in the early years, the profit and loss impact of having it accounted for as a finance lease is bigger. So the expense is bigger, meaning the profit will be smaller up until about year 6, and then only after that point does the total expense become lower for a finance lease, and so it ends up looking a little bit better at that point in time. I'm just going to sum the total expenses here. So we have $1 million of total expenses for a finance lease, and we have $1 million of total expenses for an operating lease. So in total, the expenses end up the same. It is just simply that they're front-end loaded with a finance lease, which means profit is lower in the early years and better in the later years. But again, whether that same management is there in 6, 7, 8, 9, 10 years time is there to be seen. So there is a strong incentive from not only from a balance sheet perspective, but also from a profit and loss perspective to classify a lease as an operating lease. I hope that makes sense. If you've got any questions, please get in touch. Thank you.